Good afternoon, everybody. I'm John Golliver, General Manager at the Middle East Investor Relations Association, or MIRA, the regional professional body for IR. It's an absolute pleasure to be part of the AFE Annual Conference Saudi 2021. And I should take the opportunity to thank the organizers, not least Rami and team, who of course are doing a splendid job, not just today, but also tomorrow. And I'm sure you've had a great start to the proceedings, and hopefully over the next 40 to 45 minutes, we'll be able to engage you on a very, very important couple of topics which are actually quite linked. And they are, of course, corporate ESG reporting and investor relation needs. Now, it goes without saying that we're essentially addressing the public capital markets ecosystem in the Middle East and the Arab-speaking part of the world. And what we've managed to do is convene an excellent, esteemed panel of speakers. And in many ways, what we think we'll do, by having introduced the speakers in the order that they're going to be speaking, is take a top-down view of market development. And I'd like to start with His Excellency, Dr. Ubaid Al-Zabi, who is the Chief Executive Officer of the Securities and Commodities Authority, or ESGA as we know it, in the UAE, so the UAE's regulator, with decades of experience in financial legislation, accounting, banking and finance, as well as investment, including, importantly, Sharia compliant finance. And I think for the purposes of this discussion, I'm not going to go into the full bio of His Excellency because that would take up far too much time. But I think what's most relevant, looking at the very impressive credentials, is that he is the co-chair of the MENA OECD Working Group on Corporate Governance, clearly an important part of ESG reporting. And at present, he is the chairman of the IOSCO, so of course that's the Securities Commission regulators, OECD Working Group on Corporate Governance. In fact, I've repeated myself. He's the chairman of the IOSCO Growth and Emerging Markets Committee, I apologize, as well as vice chairman of the IOSCO board as a whole. So, Your Excellency, a warm welcome. Allow me just to briefly introduce our other speakers. And if I can go to Marwa Al-Maskati, who is the Director of Marketing and Business Development at Bahrain Bourse. She's had many years experience at the Bourse. And I think if there are the biggest milestones or hallmarks that I can take out of the bio, they would be the establishment of important new markets, including the real estate investment trust market and the Bahrain investment market. Clearly an important doer in terms of the Bourse, and importantly from a MIRA point of view, the relatively recent, given that Bahrain is our newest chapter, MIRA chapter head in Bahrain, as well as a main board member of MIRA. I think for the purposes of this discussion, I'm particularly looking forward to hearing about her membership of the AFE Sustainability Committee, which again ties us in nicely with today's topic of ESG reporting. I'll now go to our other speakers, and I see we've been joined, so we have a full complement, which is excellent, starting with Adrian Rimmer, who is the Senior Advisor, Green and Sustainable Finance, London Stock Exchange. He's joined by his counterpart, Evan Harvey, who's based, I believe, in Washington, DC, with NASDAQ as head of sustainability. Last but not least, I'm very, very pleased to see Matthew Bateson, who in many ways is the gentleman at the sharp end of our conversation, in that he's the Chief Climate and Sustainability Officer at the best known company in the region, Saudi Aramco. And I don't think there's a more important industry in this part of the world, or indeed in many other parts of the world. And I think importantly, what Matthew brings to the discussion is not just his recent experience at Saudi Aramco, but having worked in other well-known large names in other sectors. I think, as we were saying at the outset among the speakers between ourselves, there is no one size fits all. At the end of the day, it's all about business, and it's all about sustainable business. And of course, while we can have a discussion on ESG reporting and IR, I think what's going to be fascinating is to take that top-down approach, which will start with His Excellency and end with Matthew. So with that, Your Excellency, Dr. Ubaid, if I could ask you, sitting in the seat of the regulator in the UAE, how do you view ESG reporting and investor relations? Sir. Dr. Ubaid, forgive me jumping in. You're on mute, I believe.
I'm mute. I'm sorry. Always take the get this
no
one thing, you know, sometimes. But you know, first of all, I would like to thank you and thank the Federation of Exchange, you know, to have this opportunity to chat and, you know, sort of, you know, having a dialogue with the practitioners in the market, which is, I believe, you know, we're going to have a fruitful discussions today and benefits from your, you know, practical experience. As a regulator, you know, it's I don't think it's no harm to listen and, you know, to see, you know, what is there on the grounds. That's one of the my strategies to get very close to the practitioners. To answer your questions today, if you allow me, I'm you know, structure, you know, my speech to the specific points here. I could start with, you know, the ascertain that, you know, the investor relationship functions plays you know, vital roles in bringing, you know, the informations and bridge the gaps, you know, between the company and its various stakeholders. That include, you know, the investors, asset managers, analysts, journalists, rating agencies, brokers, investment bankers, and regulators. So the, you know, as well as, you know, the effectively engaging with them in impactively ways to, you know, spread and, you know, have a good reports on the corporate governance and any related topics of disclosure as well. So the role of IR is a multifunctional and can be seen as a range of interrelated and equally important roles to maintain a trust among the investors in the company and outside external companies as well. So at the end, to foster a strong established relationship between the two you know, parties, internal and external parties, should be based on the transparency, investor centric approach, fair treatments for all investors, and regulated effective engagements with them. Having said that, the successful IR has to be a proactive in a way of, you know, provided information requirements for various stakeholders, as well as emerging concerns of development situations, which is, you know, anticipated in advance and appropriate actions, which is, you know, required preemptive to address those topics to all stakeholders once again. IR also directly involved in creating value for the company by making sure it attracts capital and funding for the company in a way of helping the efficient allocations of investments, capital in capital markets, and as well as improving liquidity in these markets, and then raising the level of transparency requirements. ESG and sustainability reports is also another big topic here, which has gained significant interest and tractions recently, both globally and locally. However, such reporting remain in its necessary in local market as a company is still grumbling to understand how and what, and how often evenly to report such matters in their disclosure or ESG reports or the corporate governance if they don't have ESG standards yet. Also to it's it's worth to mention that most companies are now trying to adopt increasingly. It's sort of demanding by investors and regulator the ESG standards, and to be fully transparency to mention in their reports such of standards, by assessing their current status, looking at ways to enhance their understandings of such matter, developing strategies, tools, capabilities to incorporate ESG factors in their strategy, operations, ultimately reporting of the corporate governance at the end. It's an exciting as well as challenging developing of corporates, as more and more pressure is being exerted by both investors and regulators, and even the wider society, to see corporate demonstrates more awareness and response actively to be exerted in sustainability related challenges, which is again facing today challenge from both regional companies in GCC. It's worth to mention also that IR specialists should focus here to ensure that investors, regulator, rating agency, and other relevant stakeholders are all are able to access as much information as they need to be able to evaluate and form a clear understanding of where each company stands in terms of ESG performance against certain accepted metrics. So companies in industries with this especially significance, such as industry sector, oil and gas, constructions, transportations, aviations, etc., have dedicated resource, including staff of the IR teams specifically to handle ESG related matters and disclose it in their reports. Also, it's mentioned it's worth to mention that in UAE, ASCA doing a lot of work in terms of show up the sustainability effect and concerns. ASCA taking the responsibility to use its role as a regulator to facilitator in the United Arab Emirates capital markets to actively support the achievements of the UAE national sustainability agenda through all areas that fall within its capability and jurisdictions. The master plan cover areas such as taxonomy, classifications, standard settings, legal and regulatory framework, market platforms, and investment instruments, corporate governance, the stewardships, transparency, disclosure by issuers and asset manager. Also, the awareness and education programs has been launched, including the nations, including financial inclusion programs. Also, awareness and incentives have been deployed here to get the fruitful of the program as a whole. So we are currently working with other government agencies, regulators, stock exchange to develop common set of guidelines that will highlight our principles in promoting sustainable investing, and to lead the way to provide high-level guidance for all market participants in this area, in this region as well. As to what the regulator expects to going forward in this area, whether it is term of disclosure or risk management, strategy, investments policies, classifications of instruments, or even currently working with industry groups to process, to evaluate the readiness of the companies related to regulatory authority in UAE through the detailed survey and questionnaire to engage their existence practice and to see where is their level of discrepancy, disclosure here, or even the willingness to have the ESG standards, for an instance. Also, ASCA published its revise of corporate governance rules or codes recently, with the several sanctions developed, focus on sustainability, ESG factor, strategy, decision making, disclosure of integrated reports, the board required to do so. Also, the women participation on boards, etc. Also noteworthy to mention that the recent announcements of ASCA mandate the listed companies in UAE must have at least one woman. As I have mentioned, the participation of women is on board. It is part one cluster, very important cluster of the recent corporate governance code. With this, I'm summarize the importance of the corporate governance, the importance of IR responsibility to handle these standards and responsibility in a way of dissemination of the information among the stakeholders in the financial market. So thanks. I hope I've answered your questions. Thank you.
Thank you very much, Dr. Obaid. As always, I know you're a big champion of not just investor relations, knowing you through MIRA, but also ESG. And I think it's fascinating to see the progression that's being made in terms of active capital market development. And I think you made a very, very strong point around, well, if we haven't learned something from the experience of 2020, then we're probably not going to ever learn. And importantly, as you said, that's all well and good, but to understand what each of us means in each of the markets, given, I think, different starting points, different needs with different stakeholders, it does make it very difficult to attempt to even talk about standardization or what could ideally be a uniform application of ESG reporting and indeed IR across the global capital markets, particularly when we know in this part of the world, as in other emerging markets, there will always be that competition for capital. And I think to build on Dr. Obaid's remarks, if I could turn to the Bahrain Bourse, which is represented by Marwa Al-Maskati, and just try to develop that big picture framework in terms of some of the initiatives, Marwa, that I know that the Bahrain Bourse has been particularly active in the past 18 to 24 months in terms of ESG reporting and IR. Thank you, Marwa.
Thank you, John. Of course, ESG is a mega trend and it's reshaping the value creation landscape, and it goes hand in hand with IR. So at Bahrain Bourse, yes, of course, we've tried to push forward the sustainability agenda. We've tried to push forward the importance of ESG by issuing our own ESG guideline for listed companies. And when we lead, we'd like to lead by example. And that's why we started with ourselves reporting on sustainability. And we've followed or adopted 32 KPIs that have captured the majority of the ESG frameworks, the GRI, the IR, the CDP, CDSP, TCFD, and SASP, to enable companies to cover or encompass the entire landscape of sustainability metrics. And the reason we've done that is that it will allow companies, regardless of which industry you're following, to capture the need and requirement for the sustainability. So ESG is not a reporting exercise. It's a top-level commitment shaping the organization's strategy and key materiality. It should be part of the organization's DNA in order to create potential sources of value. Within the capital market, it's no longer a niche topic, as more and more exchanges are issuing their own ESG disclosure guideline documentation. But there needs to be an emergence of standards across the GCC at least, so that there's one standard adopted by all, and that has been the highlight of the previous panel I was participating in. And then capitalizing on that, there's a growing demand for ESG from various local and regional and international investors. There's a rapid transformation of the ESG agenda. We've seen a big jump over the last 5 years on the ESG agenda in the GCC region. And the COVID-19 has just pushed it or intensified those discussions even further, because it has highlighted the interconnectedness of sustainability and the financial system. And then there goes the multiple standards issue, which everyone has been discussing. And the IFRS commitment and the statement that has been issued on that front has been very much welcomed by many parties, whether they are the regulators, the market operators, or the investors themselves. So just to summarize, I think as we enter 2021, there are strong signals of meaningful change in the sustainability reporting world. And those three main emerging trends, I'd say, would be the growing demand from the policymakers, the regulators, and the market operators, and the growing investor demand, particularly in the region, and the consolidation of the ESG standards as the steps we've seen being taken by FRS, which will shape the sustainability agenda globally and regionally. So there has been in the region a rapid level of maturity of the sustainability movement. Majority of the GCC exchanges are voluntary signatories to the UN Sustainable Stock Exchanges. Majority have their own ESG disclosure guideline. Certain statements are moved by ourselves, by ESGs, for example, on standardizing the framework has been welcomed by many. But taking it forward into the next level would be to couple in the ESG agenda with the IR agenda collectively.
Thank you very much, Marwa. Very comprehensive and very helpful and instructive, as always, as I would expect from a market operator. And I think what's always very pleasing to hear is the recognition of this competition for capital, as I always like to say, because I think often we forget it's all well and good operating in public capital markets, but you then have to go back to why you went public in the first place. And presumably part of that's to use capital markets in the future to raise capital. And on that point, I'd like to turn to Adrian. We're rather spoiled by having international representatives that span a number of continents. And of course, Adrian, representing the London Stock Exchange Group, would be based, I presume, Adrian, at this time in London. And I'm particularly interested to hear, and please take your time, what you're seeing in surveying the investment landscape, what pointers we should be picking up on, because as Marwa put it, there are key trends. As Dr. Obaid said, you know, we really do have to have learned from the past 12 months and move on. So what is it exactly you're seeing, Adrian, and what should we be thinking? Thank you.
Sure, thanks very much, and thanks for having me. I'm just going to share a couple of slides just to illustrate some examples of what we've been talking about. So if we can see that, I hope you can see that now. I think we've talked about competition for capital, and really that's very much what's been driving the agenda to date. So you know, the twin drivers for corporates to become more effective and more proactive in communicating ESG strategies and ESG data are the drivers of the investors, who really understand this now as a way of differentiating companies who have a better handle of the externalities affecting their organization, and their in turn better risk management and better ability to identify new opportunities, as well as drivers from regulators. Well, I think I'll start with the investor piece, because I think that's most pronounced and most evidence here. And you can see here, we now have over $35 trillion of assets under management worldwide that are associated with some form of ESG strategy. And that's been growing at a significant rate over the last 10 years or so. We expect that trend to continue. So the graph on the other side of the chart here is signatories to the UN Principles for Responsible Investment. And we see a similar steep growth in the assets under management associated with that initiative and the number of signatories. So we can infer from that that the trend will absolutely continue, and certainly what we're seeing in practice is that it's accelerating significantly. It's being driven by a range of factors, and as was previously mentioned, you know, there are some specific megatrends within that around climate, but also a big focus on things like diversity. And so, you know, it's important to know that, you know, there have been a series around a range of ESG strategies, but it is certainly been seen, and there was a big debate at the start of the pandemic around whether ESG would be something that would go off the boil and become less of a focus. In fact, the reverse is true. It's become much more important for companies to demonstrate they have a handle on these things, because we've seen at first hand that very unexpected and significant events can take place, and unless your company is understood and planned for some of those, or mitigated as many risks as possible, then it could be exposed. The other thing I sort of throw there is really just a breakdown of that, really looking at the growth in equity funds worldwide who are showing growth. And again, you can see within global equity funds, it is a trend around the world, particularly one across Europe, but I think it's fair to say that that's spreading worldwide. And certainly we've seen a lot of moves from the SEC in the US that is really now driving far greater appreciation and requirement to undertake an analysis of ESG risk among the US investor base, and we certainly see that across Asia as well, and in this region. I thought I'd pull out a specific example of how this is creating value for companies around disclosure of information. Now, we created a green economy mark at the London Stock Exchange back in 2019. And this was reflecting an insight we had that investors are really keen to increase their exposure to environmental solutions. And in that, I'm talking about a range of different environmental solutions. That could be sustainable agriculture, it could be water, it could be clean technologies around energy. And so they were looking to try and get insight into the revenues that companies were generating from this. It's very easy if you look at a clean tech company, a pure play clean tech, to say, well, they're green. But actually a growing number of companies are generating some level of green revenues. And we're very lucky within the Stock Exchange Group. We have FTSE Russell, part of our data analytics business, that created a green revenues taxonomy. So very similar to the approach that EU took, but much broader. And so we were able to map the revenues of companies in London against that taxonomy. It covers 133 micro sectors of the economy. And to those who make more than 50% of their revenues out of any aspect of the green economy, we award the green economy mark. Now we see from the data here, we have 95 companies. That's a small percentage in terms of the number of companies on the market, with a very large market cap and growing over $140 billion combined market cap. And they're spread across funds, the smaller AIM market and the main market. But importantly, look at when we look at the performance of those companies, they have outperformed the FTSE All Share over the past year by 42%, and that really shows the investor appetite. Now, how do you attract that capital? It's by disclosing green revenues, so really being much more granular as a company about where your revenues are achieved, and that can be both in terms of product sets, but also in terms of the types of clients that are buying your services. So in some cases, if you've got buyers that are particularly from if you're sort of further down the supply chain within the green technology world, to actually articulate the proportion of buyers that are coming from that area is also important data. So I think what we've seen is, this creates a real incentive for corporates to think about the granularity of the data they provide. And again, I think by the same token, if you look at capital raising, to access to capital, not share price performance, if we group those companies together and we look at them as a sector in their own right, I mean, of course, in practice, they're spread across all of those sectors. But if we look at them as if they were a sector, then they perform incredibly well against the other traditional larger sectors. And you see, over the last 3 months alone, green economy companies have raised a huge amount of capital relative to all of the other areas that you might think of, in terms of real estate, which again is a growth market. So I think that gives us a real sense of the ability of those companies to raise capital. And I think we're starting to see trends around that across a broader swathe of ESG issues. So I've highlighted the green economy here because it's revenue data that we can use. And so that's much more specific and less subjective. But I think in practice, we're seeing real engagement around issues of gender and diversity and around a range of other social impact issues as well. I won't dwell on at this point in time on some of the growth in some of the other areas, but I was just going to highlight the growth in funds associated with this. ETFs is a really important area. ESG ETFs up 341% year on year. So that's retail and institutional investor capital. So we're seeing a real growth in these areas and investors' desire to participate in them. And I'll just conclude for now by sort of talking about the policymaker appetite. Policymakers are seeing these shifts and they're understanding that there's a desire to create a level playing field. And so in the UK, for example, we've seen the FCA announce in terms of disclosure that it's going to increase disclosure requirements. But to the previous point that was raised, there are companies on public markets, there are companies that are privately owned. The FCA is using its powers to say, okay, listed companies will have to disclose more data, particularly around climate. But it's going to use its power with asset managers to require them to disclose data around privately held companies. So, one thing we've been keen to stress is, if you only require disclosure from the public listed companies, then you put them at a disadvantage potentially to the private equity market. But the reality is those privately held companies are as responsible for and exposed to these issues as others. And so we're seeing very sensible, thoughtful legislation come in place that really looks at the benefit of better ESG disclosure across the market, regardless of asset class. And I think that's a really important aspect of what we're doing. So I'll close with that, having given the flavour, and happy to talk further about how we're supporting our issues on the ESG front.
Super. Thank you very much, Adrian. And I think, other than the excellent statistics, which clearly highlight the growth trend behind, as has been described, not just a mega trend, but frankly, a fact of capital markets, a fact of capital market development, but also an area that I know both Dr. Obaid and Marwa would have picked up on, which is the importance of the retail market, because sometimes we forget about the next generation. And frankly, of course, the next generation, quite rightly, won't be quite like our generation, or certainly my generation. But before we come back to that, perhaps I can turn to Evan, who, interestingly enough, as I mentioned, is based in Washington, DC. And Evan, without wishing to steal your thunder, I'm assuming that's because of the importance that NASDAQ places on the topics we're talking about, and the fact that, frankly, there is a policy drive behind it, as Dr. Obaid outlined on behalf of the UAE.
I think that's right, John. And thanks for having me, and thanks to the AFE for hosting this discussion. I think that there's, there are a number of trends that we're seeing right now. I think that the escalation in regulatory engagement on ESG is one of them. It's something that has been global for quite some time, and has seems to be coming to this country and this market in a way that has been signaled by our regulator. A couple of other things that we've seen over the last year and a half. We've seen no real abatement in enthusiasm for ESG, despite the COVID and the crises that we've had here and abroad. The dislocation in work and the disruption to capital and productivity doesn't seem to have dampened the enthusiasm for sustainable capital flow and for interest in measuring performance from companies in a new way. So that was a big test for this particular trend. We're also seeing standards convergence, and I think that Marwa and others have mentioned this too, this idea that maybe ahead of regulation or in parallel with regulation, that some of these standard setters would converge or try to converge. And so we've seen efforts from the Big Five. We've seen IFRS, has been mentioned previously. We've seen what the World Economic Forum is doing. There's clearly an interest in trying to set or coalesce around a single set of metrics or standards that we can measure companies across sector and across geographies. So that will be a difficult exercise. We started this, NASDAQ has been involved with the World Federation of Exchanges and others on ESG reporting metrics for a very long time. And so the list that we have in our own reporting guide, and the list that we have proliferated through the Sustainability Working Group, we were involved in this effort, and the exchange industry, to their credit, has been involved in this effort of trying to boil this ocean of metrics down to a manageable number for quite some time. So I think that what we're seeing now is that idea finally coming to fruition and acceptance around the world. And then in addition to that, I think the other trend that I would mention is we're transitioning from this voluminous bad data era to hopefully a more insightful good data era. We have been flooding the system with unverified and unaudited data for a long time now that has some signals of value in it, but we are still trying to figure out what those signals are. Often rankers and raters, to the frustration of our listed companies, do not come up with the same scores or ratings based on the same data inputs, and that's particularly frustrating when resources are constrained. But I'll just leave you with our perspective on ESG has been fairly consistent for about 10 years now, which is that we are a listed company advocate in this process. We are trying to put ourselves in their discussion with stakeholders, specifically investors, so that they are, preparing for long-term connection with those kinds of stakeholders. And now that stakeholder audience has expanded. It has become more than just the investor, but the investor first and foremost. We've always seen ESG and sustainability as a new way to measure performance, as a data-driven management technique that you can use to have better insight in how your company is run, efficiencies in environment, efficiencies in policy, efficiencies in capital management, especially. So to us, it was another tool in the manager's toolbox in order to run the company effectively. And then, there's always the twin drivers that we talk about: risk management. So managing risks and making your company more resilient to issues, and then also opportunities. And we've certainly seen lots of opportunities in the marketplace around ESG products and services, sustainable capital flow, index creation, corporate solutions. So I think exchanges are navigating some or all of that one way or the other. They're trying to engage with their listed companies and be an advocate. When regulation comes, trying to interpret that regulation and make it sensible for companies, and also hopefully moderate that impact so that the resource burden is not so great. We all know how much companies have to report currently, and nobody's interested in piling more on top of that. So I'll leave it there for the discussion because I know we're short on time, but I mean, that's our perspective, and I'm looking forward to the comments from the rest of the panel.
Super, Evan, and this is the trouble, right? When you get big talkers on big subjects, I'm afraid 45 minutes AFE simply isn't long enough. But with that, talking about running a sustainable business and having politely listened to the last half an hour or so, Matthew, please share your perspective on the ground.
Well, it's fascinating to listen to, and thank you for inviting us along, to give our perspective. Look, I think there's nothing I've heard that I disagree with. I think the important point, I think, for a lot of companies is this maturing that we've seen as well. So there's a maturing across the board. But I think the key maturing is that sustainability is not just about reporting. And yet reporting is a key part of how you measure and actually how you can drive change in a company as well. But also how do you inform? And it's fascinating coming into a company. I was taken by your comment, John, that why do companies go public in the first place? Well, it's to seek capital. And of course, on the opposite side of that, going public brings with it a whole set of requirements that for a company like Saudi Aramco, had not been a priority and not been something that had been a requirement for the company. I mean, there had been a lot of communication. I think the company was keen to tell its story about its performance. But then with sort of listing and access to the debt markets as well, there comes a whole set of new requirements. And working our way through that is interesting, because one of the things that you realize as a company is you've got a good story to tell. You need a framework to help you tell it. And yet the number of frameworks that are out there are drowning us. It's hard enough to sort of keep up with sort of the latest without, while you're writing the report, another new set of requirements coming in. So we, like everyone else, welcome the idea of consolidation, the idea of perhaps maybe not a single set, but certainly a consolidated set of metrics. I think it's also something that one of the trends that I see, which I really welcome, is the fact that reporting is moving away from, I think it was described as voluminous bad data, Evan. I like that phrase. We've all been guilty of that, I'm sure. We don't want to be, we don't want to be issuing bad data, and certainly not volume. But I personally see that the shift of reporting for things like the Task Force for Climate-Related Financial Disclosures, which hasn't been mentioned, but it's the forefront of many industries, not least the oil and gas sector. And the intent for that to be, I think, quite a helpful way for companies to explain their resilience and to explain their rationale for their strategy, as opposed to just how has a company responded to its impacts on environment and on society. It's representing a shift that is sustainability, which is asking what are the challenges in society that impact on the business and impact on the strategy. And I think that's the key change that we're looking to. So removing voluminous data on measuring different metrics, which does show whether a company is well run, but doesn't actually ultimately show whether it's resilient, whether it's responding to societal and environmental priorities. and most importantly, whether it actually shows in, you know, that financial resilience, which ultimately is why we do this. And it's that is what, you know, drives sustainability. So I'm seeing a lot of new reporting trends, which actually I think, whilst they do increase our workload, are asking the right questions and are starting to formulate a response, which I think is causing companies to be more thoughtful. It's certainly more work, but more thoughtful in how we respond. And ultimately thoughtful because it's answering questions that ultimately are pitched by the companies that provide us the finance. You know, why should we be investing in you as a company? And if we can't answer that question, then we've got a challenge. Of course, we can answer it. It's then about how do we answer that? And my final point, I suppose, around transparency. You know, I think it's for any company, the idea of transparency is one that is easily embraced, but actually when it comes down to the implementation of it, it's much harder to do, because what you know, what is sensitive, what is confidential, what is informative, what is just noise, those are really hard lines to cross. And I think that the great thing about that is by having those discussions internally, by being informed by what we're hearing by our stakeholders, particularly our investors, that helps a company ask some really tough questions of itself. And a lot of the sustainability value, I think, is not just in what you see published externally in ESG reporting, in all sorts of disclosures, but also in the discussions that are had at management level, at board level, about why, what are we going to do? Why wouldn't we do that? Why should we set a target? What target should that be? And what does that target mean to others? And I think that is where the value of coming back to reporting and its role, whilst not being the endpoint, the value of it is it forces those discussions. It forces companies to think through the why, not just the what. And I think that's where you get value in sustainability. So, you know, these trends that we're seeing right now, I think they're all, you know, whilst they increase our workload, I think they're heading the right direction in asking the right questions.
Matthew, thank you very much. And I really take on board, having been in capital markets for many years as well, the word responsibility, because at the end of the day, you know, I mean, they're not called public capital markets with that added responsibility for nothing. I think what's been so fascinating about the experience of the last 12 months or so is, I think, everyone just being reminded, even though, as you're suggesting, I think, correct me if I'm wrong, that any sensible, sustainable business that knows how to run business through thick and thin will obviously move on and hopefully become stronger again. But importantly, with other stakeholders, waking up's the wrong word, but having a light shone on areas around, whether we call it ESG, so environmental, social and governance, sustainability, or just good business for the long term with, you know, long-term investors. It's very difficult to see us going backwards. And I'd just like in the last minute or two to see whether from Dr. Obaid or Marwa or indeed Adrian or Evan, and sorry that the time's gone so quickly, which we knew would, whether there's not a silver bullet, but in response to the, and I'm quoting, voluminous, excuse my pronunciation, bad data. Evan, you were responsible for that. I mean, I think if I was at the sharp end like Matt, I could sense a slight sense of frustration. I mean, first of all, why did you say that? And secondly, what did you mean? And last but not least, what do we do about it, ladies and gentlemen, with any parting shots?
And I didn't mean to cast any aspersions about the corporate reporters that are doing their very best to meet this cascading demand for information. I just meant that it has not followed the discipline or the rigor of the financial reporting process so far. It's also fairly new. We don't have the right metrics. And I think that Matt made a really important point that, you know, ESG is not about reporting. It's not even about reporting excellence. It's about how well run your company is and how well you explain your fitness for the future to the stakeholders that matter, specifically investors. If you're having that conversation, then, you know, you can have an argument all day long about, you know, how you calculate a certain metric. But ultimately, I don't think ESG is about the process of metrics reporting in and of itself. That is just a tool to get to that conversation.
Well, there's a lovely quote which we'll have to leave with, given that we've hit the 45-minute mark, that when a measure becomes a target, it ceases to be a good measure. Now, I think that's called Goodhart's law, but I'm afraid we're going to have to call it a day there. And on behalf of the esteemed panel who have been fantastic, and we'll obviously have to do this again, AFE, I'd just like to wish you all a great 2 days at the AFE Annual Conference Saudi 2021. And I'm very, very grateful to AFE, but also the incredible contribution of our esteemed panel of speakers today. So thank you very much, ladies and gentlemen. Have a great day and enjoy tomorrow as well. Bye-bye.
Thank you. Thank you. Bye-bye.
Thanks, John.
Thanks.
Bye-bye.